So the Federal Reserve has recently met, and what implications does that have for the dollar and for gold? In this video, I'm going to highlight what the Fed decided, the pressures that they were under, what the dot plot shift means, and how US 10-year yields show what the market really thinks about the Fed's latest decision. I hope you find this video helpful.
Hi traders, so what did we learn from the latest Fed Reserve meeting? Well, the first thing we saw is that the interest rate was unchanged at 0.25% and quantitative easing was unchanged at 120 billion US dollars per month. But here are the key takeaways that did change. First of all, we saw the dot plot change. Now, this was the previous dot plot. We had 5 FOMC members expecting interest rate hikes in 2023 and only 1 in 2022. Now, the dot plot showed a significant shift. What we saw was that there were now 7 board members expecting an interest rate hike in 2023, and there were now 4 members expecting an interest rate hike in 2022. So although initially the US dollar sold off on Powell's dovishness, looking into the detail, we see that more FOMC board members are expecting interest rate hikes sooner. That's significant. That's part of the reason for the US dollar strength post the FOMC. Now, another important point to note is that there were some upward projections for growth and inflation. Growth was expected to go up to 6.5% for 2021 from 4.2%, and unemployment for 2021 is expected to go down to 4.5% from 5%, and inflation is meant to shoot up to 2.4% from 1.8%. All of those metrics are good. All of those metrics indicate that there's a decent growth recovery in the US narrative, and you see the dot plot is telling you that board members are feeling more confident regardless as to the overall message from Powell. So because of this divergence between what the Fed are saying and what the board is indicating, many market participants are expecting interest rate hikes sooner than 2024. So that's why we saw US dollar buyers post the FOMC meeting. You can see here, dollars have been continuing to step in, and I'm doing this video on Friday at the end of the week. So a couple of things to notice. Just looking at the daily chart, I'm looking at a close. If we get a close here above that 92 level, that does open up a retest of that 92.50 region. So that's going to be a key level to keep an eye on heading into the following week. The other thing to really keep a close eye on is what's happening in gold markets. Now, one thing to be aware is, remember, a strong dollar will weaken gold. And not only do we have a strong dollar, but we also are seeing gold ETF holdings drop. Now, gold ETF holdings were key in underpinning the bullish trend in gold. We can see that gold ETFs have been falling now for 24 straight days in a row. That is a pressure on gold going forward, and we can see that gold volatility is very complacent. We can see that the 3-month volatility is trending to the downside, and that's indicating there's actually some more pain ahead for gold that the options markets aren't necessarily pricing in. And we also saw this significant event happen on Friday. The Fed announced that the SLR relief expires on March the 31st. This was some exemption that banks had, and basically made holding treasuries more attractive for banks. They were exempt from some fee that they would normally have to pay. With that exemption expiring, that now means that it's less attractive for banks to hold treasury bonds, and we've seen $80 billion worth of treasuries being sold off in the last couple of weeks. So that further supports US 10-year yields. That supports the US dollar. It remains to be seen how significant this turns out to be. However, one key market to look at is the gold market, and I just want to show to you a key area. Just going to drag across my other screen, and I'm just going to show you, just one moment. There we go. And I'm going to show you a key area of resistance that we have for gold. So one area that you will expect sellers to be leaning against is to be leaning against this key resistance level. Do you see it's the downtrend from January the 1st, 21st, and you can see that clear trend line to the downside. It's drawn a little bit inaccurately. Let's just tighten that up a little bit, and we can see here that price is just testing that resistance level, just testing that horizontal resistance level around that 1760 region, and we'd expect, as long as this strong dollar, gold ETFs keep falling, we would expect sellers to be leaning against this level with stops above and looking for a retest down at that 1680 region. So that's the latest we have from the Federal Reserve, and the bottom line is the market is expecting the Federal Reserve to be more optimistic than the Fed is currently letting on. And as long as the US economic recovery is expected to be faster and keeps gaining pace, then that should support the US dollar in the medium term. We'll have to see how the run of economic data progresses, and the latest talk from the Federal Reserve will be giving us an indication of where the US dollar and where gold will be heading over the next few weeks and months. Certainly an interesting point, and certainly a key time to be looking at the US dollar and what the Federal Reserve's latest move is going to be. We'll keep you updated. Don't forget to follow my blog. Keep in touch, and I will update folks with relevant changes as they come to pass. Thanks for watching this video. If you'd like to keep in touch with me, there's a number of different ways you can connect. First of all, you can follow me on Twitter at Giles Coughlin CCA. That is my Twitter handle. You can also follow me at LinkedIn and catch up on a number of my posts. If you just take a look here at my Twitter page, you can see my Twitter handle is just down here at Giles Coughlin CCA, and you can follow along with my latest tweets. Also, at LinkedIn, you can follow my profile here, and you can find out some of the latest posts on the market that I'm making on my LinkedIn profile page. Not only that, you can also follow me at my blog. Now, this blog, I spend a lot of time making sure this blog is up to speed and is being kept updated with significant and latest market news. You can maybe go along and have a look at my central bank site, have a look at key market events, trading insights. There's a whole host of different resources on my blog, including looking ahead to the coming week. And not only can you keep in touch with me in those ways, you could also email me personally. I've put together a number of great traders, and I have some really good programs that I can share with aspiring traders, which can support them in their learning process. As well as more advanced traders, I have access via HYCM to a number of professional tools which can be offered as part of a package for those using HYCM as a broker. Please contact me to find out more details. Also, finally, don't forget on Mondays you can look at the week ahead live market analysis, and on Wednesdays I have a workshop where I identify a currency pair for trading for the day. And the Monday live market analysis, you can register for that on my blog. You just go to my blog, go along to live analysis, and on the live analysis you will have a link on the HYCM lab, and you will be able to register for some live analysis. You just go to the banner that's at the top, and you just go under this banner, register now, and you can type in your details and register for the Monday webinar. And then I'll be taking us ahead what's coming up, and you can see recordings of the webinar underneath and keep updated with the latest market moves. I think you'll find it a very helpful time, and you also have opportunities to ask me questions. So really do focus on providing a good education for traders. I hope to see you there. Goodbye.